Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamatic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional guidance and advice, or call your RIA, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Yep.
So what do we have going in the pre-market this morning?
Yep. Let me share my screen real quick. And, quickly before we do get started, the reason we do this show is to answer questions you guys may have about the Market Chameleon tools, data, analytics. Also, if you want to bring up anything unusual you've seen or strategies, you can bring that to our attention or come on a show, talk about it, discuss it. Maybe it should benefit everybody in the community. The ways to ask questions is, one, you can put them on the live chat on YouTube. Will's watching it, he'll read them back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. Click on that link, it takes you over to Zoom. Once you're in Zoom, there's a button, raise your hand. Click on that. Everybody could hear you once we let you in. You don't have to turn on your video camera because it will prompt you if you want to turn on your video camera. While we're waiting for questions to come in, what we'll do is take a look at the pre-market report, see what's trading the pre-market hours. And if we don't have questions come in, I'll default to some of the questions I get in the emails. I think I got two of them right now queued up that we recently got. One of them had to do with early exercises. So we'll talk about that.
All right, perfect.
Okay. So pre-market report. These are stocks trading in the pre-market hours. We have our most active list, our biggest percentage gainers, and our biggest percentage decliners. Down here, I see 49 stocks made our percentage gainers list, 64 on our percentage decliners list. From this perspective, we're looking like a slightly bearish bias at the open. But if you look at the list, you'll notice that there are small cap stocks in there, ETFs, preferred stocks, leverage products, anything pretty much that trades on the major US exchanges can make this list if it's trading pre-market hours and it hits our conditions. What we want to do is narrow down this list to get better insights to some sort of grouping of stocks, and we'll narrow it down to S&P 500 companies. And to do that, I'm going to use this filter here in ETF, drop it down, and now you get a list of ETFs to choose from. This first one, SPY, that's the S&P 500 ETF. When you click on that, the list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we see 10 stocks made our percentage gainers list, 10 on the decliners. From this perspective, we're kind of neutral at the open. Just as a note here, when you see these stocks, these are the symbols, this column here alerts, lets you know if there's news in the E is earnings. So if you hover over, you can see that their earnings either was just reported today before the market's open, or yesterday after market close, and the stock in a pre-market is most likely reacting to that news. And we're getting a lot of E's now, so we are in earnings season. On top of that, I believe, is it tomorrow the Fed's meeting? Well,
yeah, well, I think it's maybe today and tomorrow.
Yeah. And right now, I think the consensus is starting to build up that we're going to get potentially 2 more hikes, quarter of a percent each, and then pause. Right. So that's the consensus, but we'll see what the Fed is thinking, what they're seeing, and how they guide us. But I think that in general, if you're looking at the markets, they're pricing in that we're kind of at close to the end of big rate hikes, and maybe, we got 2 more to go. And then there was a pause. So we'll see what they say, but obviously everybody's watching that. And there'll be a lot of news around that. Let me see. If there are no questions, then I'll probably take the question of early exercises.
All right, perfect.
And before we get in, let me see let me just default to SPY. The question came up, I think, in the context of, well, there are these trade ideas, and a lot of the trade ideas can be a spread, right? So when you're doing a spread, you're buying an option and selling an option. And it was in the context, well, I don't want to trade spreads because there's an early exercise component, which is true, right? So you're going to be short an option, and if you're short an option, the person holding that option can exercise it and forcing a delivery on the stock. Okay, so whether it's a bull call spread or bull put spread, right now you can end up with an option that is beneficial for an early exercise, and that's due to cost of carry, dividends, and so forth. So somebody with when you end up with a deep in the money spread, it can be a candidate for early exercise. So before we go over the early exercise, I kind of want to go back and explain to you how these questions are formed, all right, to me, because sometimes the questions are formed in a way where, all right, let me put it this way. A lot of our customers are already like professional, know what they're doing. They really don't need help. So we do get a lot of those. And really they barely ever ask questions. Then you get like the intermediaries, but sometimes I get people asking questions that, to me at least, sound odd, where you would say, something like, well, I don't have time to learn this, it's too complicated. Just tell me how to do without learning it. And there's no way to do that, right? Everything, when you're trading, you're very active. It assumes you're doing things efficiently, right? There's no way to say, do this, assuming you're doing things inefficiently and not rationally. Okay. There's no way to create a tool that makes that assumption. I'll give you an example. I'll give you a football example because, I'm from Philadelphia. Eagles are going to Super Bowl, so I'm going to use a football example. And you can't come up to somebody and say, look, I want to win the Super Bowl, but this game is too complicated. Sometimes you want to kick a field goal, sometimes you don't want to kick a field goal, and how do you decide when to kick the field goal, or when to throw, or when to run? I don't have time to learn all this, right? So do you kick the field goal when you're close, when you're far, based on how much time is left? I don't want to learn all this. Just tell me how to win. So there's no way to tell somebody how to play the game right if you're going to say, well, I'm going to go out there randomly and start kicking field goals, throwing, things around, downing plays, doing things that you don't know what you're doing, but tell me how to do that and win the Super Bowl. Like, you can't do that, right? The whole thing is that you are learning how to do things efficiently, right? That's the point. And that's why when you have even a Market Chameleon tool, it's not for, you have the ability to go back and look at things and test things. So you can't say, I want to act inefficient and irrational, but tell me how to be successful, assuming that I'm going to be doing that. I can't, there's no way to do that, right? So it always assumes that you're acting rational and that you're acting efficient and that you understand what's going on. And if you don't, you have to take time to learn. Okay, there's no other way around it. It's not passive. Trading is about you being active, reacting, and so forth. And you need to learn. Okay, there's no other way. There's no trick that neither I nor anybody else could say, go out there, act like a fool, but even if you act like a fool, if you do this, you're gonna be successful. There's no way around. Okay, and I'm only saying this to the few people. Most of the people don't do that, right? I would say 90% of the people that I talk to and stuff really know, but we do get certain people that do say that, and there's no way I could help them. And sometimes they get upset at me because they think I'm not, like I'm holding some secret back. But you do need to learn, right? You need to learn about these things. And if you're scared of a spread, to do a spread, what that means is you didn't learn enough about it. Okay, you don't know enough about it to trade it, so you shouldn't trade it. And at least if you're scared, that's telling you don't know enough about it. But all right, so coming back to a bull call spread, right? Why would you get assigned? It's not only that you're going to get assigned, right? That you should know, but you should know when you should be exercising it yourself. Because if you don't know when you should be exercising yourself, you could think, well, I have no risk, I just don't exercise it. But that opportunity lost is trading inefficiently. You can't just continuously do that, because if you have a call on and you should be exercising it, that means you're leaving profits and capital on the table that you shouldn't be doing. So it's important that when you're trading, whether you're trading a spread or not a spread, if you have an option that is a candidate for an early exercise, you should be exercising that option, or all you're doing is incurring a loss for really no reason, but just like either your lack of effort to try to educate yourself. But let's take a look at why would somebody want to exercise a call. All right, either a spread or you're long the option. Why would you want to exercise the call? So let's assume here we're in SPY. All right, so in SPY it's $400 stock, and I'm going to go out here and let's just say I'm holding a February option. I'm making these assumptions now. So SPY is not reporting a dividend. I'm just doing this as an example. And let's say you own this really deep in the money call, right? Let's say SPY is 400 and you have a $360 call with 2 days to go. And you got lucky, the stock went way up and you're like, well, what's my risk? I don't have to exercise this option. I could just hold it and, till expiration, then sell it out. So you have this deep in the money call, and let's assume that the stock goes ex-dividend today and SPY is going to pay $1 in the dividend. All right. And if that's true, then you got to decide, do I hold on to my option or do I exercise it and convert it to stock? All right. And this is where you have to make a decision if it's economically beneficial to exercise. And if it is, then really you should be, because otherwise you're just leaving money on the table. And why would you want to exercise it during the next dividend? When you hold an option, okay, it's important to understand that a regular dividend, when the stock pays a regular dividend, it only pays the regular dividend to actual shareholders. So a person who owns an option doesn't get that dividend. Okay, so if you hold the option, you don't get the dividend. If you have the stock, you do get the dividend, but you have to own the stock before the ex-dividend date. And if you have an option that basically behaves, moves up and down, if it's deep in the money, like this one, let's say, if it behaves like the stock, in other words, it's so deep in the money that if the stock goes up $1, the option goes up $1. The stock goes down $1, the option goes down $1. Then, and if you see that, let's say that the put is almost, let's say it has to be worthless, like just for this example, okay? It doesn't actually, it depends on the size of the dividend, but let's just say the put is worthless. Then you have to decide, well, if I exercise the option, I convert it to stock, so my risk profile is the same, right? Wherever the stock moves around, and I get the dividend, right? So now, not only is my risk profile the same, right? But I got this extra $1 dividend, right? So if you own 10 options, you get $1,000. And if you don't exercise it, then you don't get that $1,000. And over time, this all adds up. And there's no reason for you to give that up, right? Because how do I protect my downside then, right? So let's just say you're worried that, hey, Dimitri, yeah, I don't want to exercise this because I'm going to own the stock at 400. But if the stock goes to zero, let's say it goes to zero, then I'm out $400. But here, your argument could be, I'm only risking $40, right? So that could be an argument. So the next thing we could do is look at, well, how do I protect that downside? Well, if I could buy this put for 2 cents, then I'm protected. It's the same thing. If I exercise this, I'm long stock, and I buy this put for 2 cents, I essentially got a synthetic call anyway. But the difference is I also got the $1 in dividend. So basically, if you look at the put call parity, right, and you say, well, should I exercise it or not? And you're looking at all the options on the board and you're saying, well, yeah, I could buy this put for $2, exercise this call, convert it to stock and get the $1 dividend, then it becomes economically beneficial to do it, and you should do it. Okay. And any tool you're looking at, any analytic, anything assumes that you're acting rationally all the time in doing that. Okay. And if you're worried about it or not sure, then you just need to learn more about options before you trade them. Okay. So that's a situation where you should be exercising. Now, of course, if you're short one, right? Let's say your spread is your long one here and your short one there. Well, if you're worried that somebody, is going to assign you on your short, right, because it's economically beneficial, then if you're long an option below it, then it's definitely economically beneficial for you to exercise. In these situations, in a long call spread, the most likely scenario is you're going to exercise yours and you're going to get assigned, and the next day you're just a wash, right? But what happens if you don't get assigned, right? If you don't get assigned, if you exercise yours, but somebody forgets to exercise theirs and you don't get assigned, well, what will happen is you're long the stock and short the call, right? So that's what's going to happen is you're going to come in long the stock and short the call. So you're basically, if you have a deep in the money call, your long stock is going to be offset by that short call. So some of that risk, right, unless the stock just breaks all the way down, you're going to be still hedged. But on top of that, you're going to receive that dollar dividend. So in reality, in a perfect world, you almost want that to happen. You want to be able to exercise your call. They could get the long stock and the dividend, and you want somebody to forget to exercise their long call, because what it will do is leave you with a position like this, right? You're going to be short the call. Here, I'm going to take it out. You're going to be long 100 shares of stock, right? So you could see here, I mean, this is just looking at it if you sold it at, below parity. But you could see here that you're going to come in and your position up or down is hedged, right? Until you get to closer to that strike. So if you're way deep in the money, and the stock has very little chance of going down there, right? You're going to come in hedged. And then the next day, if that happens, well, you could, what can you do? You could go and just buy this put and hedge that position, right? So if somebody forgets to exercise it, you could go and just hedge yourself by buying that put, because you already received the dollar. So you could go and buy that put for whatever, 2 cents, 3 cents, right? So it's important to understand clearly, when things are an exercise, what your positions will be if you get assigned, and what your risks are before you get into it. And if you don't, you're not ready to trade yet. There's no urgency to go trade right away. You should really be spending most of your time learning these things, before you go out there and just trade. I think that sometimes there's like this feeling of, well, I need to go and do executions and trades. But in reality, most of your time should be, learning. So that would be in a situation of a call. Okay.
AD?
Yeah.
Chris is asking, my understanding is the OCC only auto assigns the front month contract for any option in the money by 0.01 or greater, and the back months are assigned by option owner. Is that correct?
So the OCC will only assign on expiration. We're talking about early exercise, right? So this is not an exercise, at expiration, right? Yes, at expiration, the OCC will automatically do it. This is an early exercise. So it could be days before the option expires. It could be a month before the option expires. It could be 2 months before the option expires, depending how deep in the money it is and how big the dividend is. So we're specifically talking about an early exercise. Okay?
And it's only at expiration, the expiration day.
Right. So what you're talking about is an expiration day. So what about expiration day? Let's say you do have a spread on, right? Let's say you do have a spread on, and let's say you're long one. Oops, sorry. Long one. Or wait, let me do it the other way. You're short one, you're long one. So you got a credit spread on, right? Credit call spread, credit put spread. So you're short the 400 and you're long the 402. So this is a good question. What about expiration? That was the example I gave. Was you would actively have to go and do an exercise for dividend. Okay, the OCC is not going to do it for you. Nobody's going to have to do it for you. No one's going to do it for you. You have to be watching it. That, hey, I should be, putting in an early exercise. And you got to be careful when you do these things, but this is when you're managing your positions, you're managing your risk, and you're saying this is economically beneficial to do it, and I'm going to do it. Okay. Here, this is a little bit of a trickier situation, early exercise, because let's say you have this credit call spread on, and at expiration, here, let's do it even closer to us. Let's do today's. right? Let's say you're short the 400, long the 404s, okay? And let's say at expiration today, the stock is at 402. Well, here, now you got to manage that position, right? You got to manage that position because if you do nothing, the call that you're short, the 400, that will get assigned, right? So that's going to get assigned and you're going to come in short the stock. And there's absolutely no reason for you to exercise your 404 call if the stock is at 402. That wouldn't make sense, right? If you could buy the stock at 402, then you should not be exercising the call at 404, all right? Because that means you would be buying the stock $2 higher than really it's at right now. So then what do? And you have to make a decision here where either you close out of that call that you're short, so you try to get it at parity, right? Or you'd have to buy the stock right at the bell, assuming that you're going to get assigned on. There is a little bit of extra risk here because the option may not get exercised depending on what the stock does after hours. So if the stock does plummet after hours, you could also enter a do not exercise. So you could tell your broker, I don't want to exercise this call. So let's say, for example, that the stock closes at 402 at 4 o'clock. So this call becomes an automatic exercise by the OCC, let's say, right, based on that closing price. But something happens after hours, and like maybe there's like bad news, some like a hedge fund like says they're liquidating, or something really bad happens. The market drops, and all of a sudden SPY is $398. Well, the guy who owns this call can say, I don't want to exercise my call for 400 because the stock is trading after hours at 398, and I could buy it at 398. So why do I need to exercise my I don't want to exercise it. So he calls his broker and says, I'm going to put a do not exercise in. So what will happen is there's a chance then you don't get assigned on your call, right? You're not going to sell it. And you may come in, if you hedged it by buying the stock, you'll come in long that stock because it won't get called away. These are all risks that you have to manage, and know, because if you trade options, there's no way around it. You have to know that these risks exist, and you have to know how to trade around it. Okay. And there's nothing you could do to say, well, what do I do to avoid these things? Because these are basically part of the options risk and part of trading, right? There's no real way around it. So the best thing to do is just know those risks exist, monitor those risks, and close them. And you could close out those risks, throughout the day or whatever, manage it to the best of your ability. But if you're afraid of those, then as you get closer, you could always close out of them.
Hey, Dean, we are getting, and maybe we can go into it, carry it forward to tomorrow because we're right at the opening bell. Michael McCrae is asking, please explain the difference between European and American style options in terms of early assignment. Maybe you can go over that tomorrow.
Yeah. So let's do that tomorrow. So we'll talk about the difference between American and European. Yeah. All right.
Awesome. Great job, my friend.
Yep. Thank you for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Awesome. Trade in peace, chameleons. Have a great day, everyone. Bye.